Welcome back. You're watching Stockwatch with me, Juliette Televi, and join me to take your stock-related questions this evening are Jean Pierre Verster from Protea Capital Management and Graeme Körner from Körner Perspective. If you'd like to send questions, please SMS 41392 or email stockwatch@bdtv.co.za. Graeme, Jean Pierre, good evening to you both. Graeme, if I may start with you, it was a bit of an ugly day on the market today, and it seems to be all the incredibly strong US economy's fault. And in fact, IMF coming out with a report saying the US is going to be the strongest among the G7 countries this year, and that's really bad news. So can you explain that to us, why it's all such bad news?
I think the argument is that that maybe the Fed will go slower because it also comes on the back of a higher than expected and hoped for inflation print number. So I don't know. I think that's probably it. But I think, the tensions in the Middle East, I think, also play quite a significant part in the weakness in not only in the South African market, but around the world. You saw Asia taking a beating and Europe, anything down, anything from 1% to almost 2%. So I think it's a combination of things. There's just, I think, a heightened anxiety. I've obviously seen, the magnificent 7 shrink to the fabulous 4. So I think there's just a bit of a recalibration happening at the moment. But I think the markets were spooked around the growth implications of an escalating Middle Eastern war.
Yeah, I mean, especially with Israel poised, no one is. I think the FT said they only have bad choices open to them, and that's never a headline that you want to read. Jean Pierre, I think it was also an FT article I read, and hopefully I absorbed the information correctly, but is it the biggest gap between government yields or longer dated, shorter dated US Treasury yields versus dividend yields in US shares, i.e. it's a much safer and easier place. It's sort of a no-brainer place to put your money into government bonds rather than the stock market, and is that one of the problems that we're seeing, or being playing out in the market?
Yes, well, as far as I know, it's sort of like the smallest gap, because for quite a long time we had such a low 10-year bond rate, and your dividend yields that were, call it 2 to 3% on the S&P, but you only got less than 1% on a government bond yield. So a government bond wasn't really an alternative to the market. What you have now, if you're getting 4 to 5% on a 10-year bond versus your 2% on a dividend yield on the S&P, it becomes a real alternative. So a lot of people are saying, why should I take equity risk? Why can't I just, instead of picking up a 2% dividend yield, and who knows how much it's going to grow by every year, it might even shrink in the year to come, I can just stick my money in a 10-year government bond in the US with just about no credit risk and get 4 to 5%. So I think that is a huge shift in the flows that we've seen that have powered equity markets for a number of years when yields were artificially low. And up until very recently, people thought, well, maybe yields will go back to be artificially low. We've slain the inflation dragon, and maybe that's not the case. Maybe yields will stay at this rate. And I see even 1 or 2 economists saying maybe we'll get a hike in the US.
Yes.
That would be interesting.
Yeah.
So flows do definitely play a big part in what we've seen in some pressure on stock markets. But then again, stock markets have done so well, not just year to date, but even over longer periods. You would expect some breather. They can't just go up in a straight line.
Yeah. In fact, it was only, a couple of years ago that we were talking about the TINA trade. There is no alternative, to equity markets because you weren't getting anything in bonds. Sorry, and the author of the article that I read this morning was John Authors, the Bloomberg columnist. Graeme, there's a question on resources stocks because they were under particular pressure today. And the question was, last week I saw some light with commodity shares like Amplats and Anglo. Thought that was the turn, so I didn't sell. So I've gone from 5% up to 5% down in 7 days. Now what? What would you do?
Yeah, I think, Juliette, you've got to look at each underlying company. Obviously, the fundamentals for BHP, for example, are very different from Amplats, which would be very different from Impala, for example. So it's difficult to answer it generically. I will say that for quite a long time, we've had very, very limited, and in some client portfolios, almost no commodity exposure. because you saw commodity prices run up. Obviously, the stocks went along with that, and now we're starting to see, production costs going up, and maybe in some commodities more capacity coming online. And obviously, the big question about what are those big consumers of most commodities? We talk about the industrial complex, China principally. What are those economies looking like, and what is demand going to look like for iron ore or copper? So I think my sense is that I'm warming to diversifieds, for example, like Anglos. I think it's going to remain choppy for a while because the world really is battling what you were talking about earlier about, the US suddenly is going to be the driver of global growth. It's partly because the US has been strong, but it's also because the rest of the world has been anemic. So I think the backdrop is not great, but the point is that you buy commodity shares, when the outlook is improving rather than maybe 2 or 3 years ago when the earnings were flying. Yeah. So I'm warming to them. Okay. If you take something like Amplats, we had a bit of a false start in the recovery in the PGMs the other day, but I do believe that a lot of capacity is going to come offline. You've seen the platinum producers in SA or PGM producers announce quite big cuts, and Twickenham, for example, is mothballed. So I think it's a question of time before demand returns, maybe from some new areas. So it's a long answer. I think in the case of something like Amplats, I would definitely hold it. I think it's going to be bumpy, but I think there's quite a lot of optionality there. But you're going to be up 5 and then you're going to be down 10 the next week. That's the kind of world we're in now. If you haven't got the stomach for that, just stay out of them. I think that's the best I can do.
Yeah. Jean Pierre, do you have stomach for the commodity roller coaster?
So, if you're a permanent bull when it comes to commodities, specifically gold, people refer to you as a gold bug. Now, I'm probably the opposite. So I'm probably a commodities anti-bug. At most times, I'm quite negative commodities. You correctly refer to them as a roller coaster ride. So, no, I'm not a big fan of roller coasters, especially when they dip a lot. So sometimes going up and up and up is a lot of fun. And then you get to the top and all of a sudden you're like, oh no. And you know what's coming. So that's how commodity markets typically are. So no, I don't have a stomach for that. Although I do have a stomach to short commodity stocks. And we have a small gold mining short. Oh. So maybe my risk tolerance is higher than what you might think and what I've just explained, because that's also been an opposite roller coaster ride. But because it's small, it doesn't hurt us too much. So no, I'm not a bug. I'm an anti-bug.
Yeah, you're a commodity bug. You're a commodity bugbear. You could say.
That's it. Well done.
So if I can add one thing, Juliet, I think generally the principle is be in the best of class. So if you're going to be in commodities, be in a BHP Billiton where there's low production costs, and they're less dependent on the markets. And equally, that's why I would probably argue with somebody like Amplats, especially because they've got a big boy brother in the corner. So I think my point is, avoid the highly marginal speculative guys. If you're going to play this game, then rather focus on the better quality companies.
Okay, then I don't know how this would fit into either thesis for the bugbear and the high quality adherent, and that's a question on Alphaman, which is an interesting share, admittedly, and you could have ridden that roller coaster pretty well either way. But the viewer says, can I have the panel's view on Alphaman Resources regarding tin, especially in AI hype and computing, and also its production doubling this year? Graeme, you said before the show, I asked you if you have a view on Alphaman. You said no. Jean Pierre, I don't know if you have any views on it, or if it's we'll have to move on.
I'll give some thoughts. I think the first thing is, even though I've given this broad sweeping comment about commodities, you do get some commodities which have got a very concentrated supply. And they are a bit different. They aren't typically commodities, as the word would imply, because they can be scarce. And when it comes to those commodities, the mines that get the ore or the metal out of the ground can be very profitable businesses. And Alphaman is one of them, because tin is relatively scarce, and they've got just about the best tin resource in the world. And as you correctly said, if you think about AI and chips, tin is used in soldering on boards, integrated circuit boards. But it should also be said that these days, your bonding is not necessarily tin related when it gets to the microscopic level of what some of these chips do. So I wouldn't necessarily say that Alphaman is a play on AI. I wouldn't go that far.
Okay.
But I would say it's probably a better opportunity to buy into a commodity company, a mining share, than most others, given the supply constraints and the concentration of supply when it comes to the tin market.
Graeme, I don't know if you want to add anything there, specifically on the tin market, because it's a real rarefied corner of the commodity sector.
Yeah, but I think that the thing is that if you've got a really strong feeling and you believe that circuitry is the future and that tin is going to be in demand and the market is going to remain tight, then you can have a swing at it. But I'm going to use Jean Pierre's words. It's too much of a roller coaster. There's too many unknowns, and you just need a little bit of a dent to your investment hypothesis, and suddenly the whole game comes to an end. So I don't have anything to add other than I'd probably sit it out because I don't understand enough of it.
Yeah. Okay. One thing that almost turned out to be a sure bet was the Canal Plus offer for Multichoice, and there's a question specifically for you, Jean Pierre. But Graeme, I'd also like to get your thoughts on it. On whether you've sold out of your Multichoice position as 125 Rand looks like the final number. Have you?
Yes, I have in the last few days. So it was my stock pick, I think, a couple of weeks ago before they came out with a firm announcement, because in my mind, it was a foregone conclusion that they would come out with it. So we sold in the last few days, because if I look at the time value of money, if 125 is going to be the last offer, then I'm happy to take the current price. There is a risk that because of the Electronic Communications Act requirements, that effectively what you get is Canal Plus have made an offer. There are some conditions to the offer, and not all conditions are fulfilled. But in the meantime, they claw up their way in the market up to 49.9%. And then they're like, oops, okay, no, sorry, the offer can't actually be concluded. Not all conditions can be fulfilled. And they effectively sell Multichoice SA down at potentially even a loss, but then they are back in line with below the threshold for foreign shareholding in a local licensee, but they own 49% of, effectively call it the African business, Multichoice Africa, which is what they really want their hands on.
Yeah.
So that is, I would say, it's a curveball. It's an outside risk. But because of that, I was happy to take the current price. There's a small risk that you might get, for whatever reason, that they sweeten the offer. But with the board already having said they're now working with Canal Plus, I do think this has become very friendly very quickly. And that's why I like the current price.
Yeah. Graeme, I think you were quite, well, you didn't have any and probably quite happy to get rid of them a while ago. A question on Estee Lauder, however, and it is, I have been on the sidelines on whether to buy Estee Lauder shares, but to me, the industry seems like there has a lot of competitors. I want to buy it and hold it for a long period of time. So does the panel think it's a good buying opportunity now? Graeme, is this one that you look at? Estee Lauder and I suppose L'Oreal?
No, not Estee Lauder specifically. If I may say, I mean, somebody starts with, I've been watching them for a long time. There's a lot of competitors. So I'm not sure if it's a good industry. Well, I think if that's your hypothesis, then I wouldn't try and force myself to buy the thing. Yeah, no, I would not be there. I think if I look at the earnings forecast, it's this is going to be a pretty tough year, and it'll probably rebound. But still earnings are down on what they were a few years ago. So that's not a great recipe for me. I think you can buy higher visibility, and maybe you can get similar sort of exposure. Obviously, the P&Gs of the world have got personal care products, but they've got other stuff as well. And maybe that diversification gives you better visibility and quite possibly more consistency and better fundamentals. So yeah, unless you've got a really compelling reason to be there, I'd ask why do you even want to consider investing in something that you feel is overly competitive?
Yeah. Jean Pierre, your view, and is it that competitive, or is possibly the viewer thinking of the actual individual brands? Because as far as luxury sort of beauty companies go, there's not that. I wouldn't have thought that there are that many, but I stand to be corrected.
Yeah, so firstly, Estee Lauder has lost quite a bit of ground against L'Oreal, and the share price has underperformed sharply versus L'Oreal. But then also, when it comes to cosmetics, it's a great industry if you look at the economics of it. You know, how much it costs to make these cosmetics versus how much you sell it for. And you use the term luxury good, but it's sort of an affordable luxury good. I would rather call it a premium good than a luxury good. It's not just the top 1% of people around the globe who can afford cosmetics. It's a bit of a wider market than that. But the other interesting thing is that what has happened more recently is that you've had niche brands. A lot of brands that people have started and use cosmetics on themselves and have a huge social media following, like
Kendall Jenner. Yeah.
Yes, exactly. And there's a few other, like 1 billion. I think Rihanna also has got a $1 billion cosmetics brands. And there's another company that listed recently, which also went through the roof because of the way in which they sell cosmetics. So it's a personal care product, and that means that people feel very intimate about their cosmetic product. That's a very positive thing, but that also means that if you haven't stayed with the times and use social media where people can actually show you, you know, how to put it on, how to do stuff and create that intimacy with the product, then you've lost ground. So Estee Lauder has lost a lot of ground, sticking to the more, you know, big billboards types of marketing spiels. So if you believe that they can right the ship, and the fundamentals of the industry at least is still very positive, it's sort of like a turnaround story. Yeah. So then if you zoom out and you say, what's the probability of things turning? Unfortunately, I would say less than 50%. Normally when things go bad, they don't just turn on a dime. Yeah. So I would be cautious, but I definitely keep it on my radar because of the strength and positive attributes of the cosmetics industry.
I mean, clearly, neither of you are getting sucked into Instagram's black holes of watching makeup tutorials at 3 o'clock in the morning, which I am embarrassed to say has happened to me. But I think there's a company listing. It's Puig. It's a Spanish group, owns Paco Rabanne and Charlotte Tilbury, which is a very big Instagram a friendly brand. And then one to consider is LVMH owns Sephora, which is, of course, the huge chain that sells, a myriad of products, and it's affordable luxury, which is quite an irony that it sits within the LVMH group. I mean, are those things that maybe you might point investors who might be keen on the segment towards rather?
Yes.
I think my concern is, if you take LVMH, they sell handbags for, $1,000, and then they sell other products for more aspirational sort of mere mortals types. But the problem is that those mere mortals are the people who are more exposed to interest rates in the UK, heating prices in the UK. So what I'm saying is I think the more affordable sort of the premium brands, as Jean Pierre calls it, I think they are far more vulnerable to disposable income than is a Cartier or an LVMH or Moët and Hennessy. So I think my concern would be companies like this are probably listing because there's a bell ringing and they say we bloody well better list this thing before the market goes. So evaluate every opportunity, but I think the point is that, as Jean Pierre said, there's a lot of competitors, smaller competitors, who are using social media and influencers to penetrate the market. So it's not just competing with the big guys anymore. There are lots of small people who are clamoring for share of wallet. But I would say that I think in a lot of parts of the world, disposable income is actually under pressure, and it's probably that type of buyer. So I would not run out and buy them. I'd let them settle and see where the market actually ends up a year or two from now.
Yeah. I just have to say, I fear there are a lot of people who would rather have a great set of a great face and maybe be living on cat food in the 80s than you realize. So don't underestimate that sort of phenomenon. Moving on and to CGRO. The viewer says, CGRO was picked as a hot stock by a renowned financial journalist yesterday. What is the panel's view? Jean Pierre, have you looked at CGRO recently? Because they do seem to have been doing quite well.
Sure. I've looked at CGRO for more than a decade, and I like the management team, a relatively young management team doing dynamic things, very entrepreneurial. And this business has gone effectively to hell and back. If you think about all the issues they had, a lot of their sites where they could not continue developing, but they need to pay their finances, and some of the competitors went out of business. Some other developers went out of business. They've got this huge tract of land literally in the middle of Gauteng that they're going to develop over the next, who knows, 20 years. That could be a huge opportunity for them. It will take capital, so they need to be very careful in terms of matching the finance they raise, which will probably be mostly debt finance, with the infrastructure and the cost of developing that tract of land. So I didn't like it too much a while back. I thought there were too many risks around. The higher interest rate environment is not good for them, so they're not out of the woods yet. But there seems to be a little bit more life, and there was a big shareholder, some US endowments that ended up with shares via an unbundling of an investment fund that was sort of looking to sell their shares, and they have now, more or less. So that's also behind them. So I think CGRO looks okay from where we are. It all depends on how well they just manage this huge pipeline of development. A company like Baldwin has showed you that a big pipeline is one thing. Capitalizing on that pipeline and turning it into cash profits is another.
Yeah. Graeme, do you look at them at all?
Yeah, I've looked at them and on a number of occasions and then concluded, interesting story, good management, brave, entrepreneurial, as Jean Pierre says, but then just never felt, any real desire to buy them. I think the other thing is that, building in South Africa is difficult. I was chatting with somebody who owns a lot of residential units, really a lot of residential units, and they just said it's becoming really difficult, with building costs. So, the theory of, building costs are up to 18 or 20 or 25 at a point in time, and don't worry, there will always be a market. I'm not sure that will actually hold, because affordability is an issue. So I think they will probably, as Jean Pierre says, roll that development out in that massive tract of land over a few decades. But it's going to be difficult, especially in the early days. So it looks as though it's clawing its way back from hell, as Jean Pierre put it. But I think, there's just so many compelling stories out there where you can buy, good business models with high visibility at very good prices. You don't have to convince yourself to buy in the South African market.
Yeah. Okay. All right. Well, two shares that neither of you need absolute convincing to buy. Your stock picks this evening. Jean Pierre, what would you be going for?
So Transaction Capital is my stock pick tonight, Julieta, which might be a little bit of a strange one, because we've just had the We Buy Cars unbundling. But that is exactly why we've seen Transaction Capital shares, the rest that is left over, which is basically Newton, a debt collector, and then a ring-fenced SA taxi business, and some cash at the head office. The share was down sharply today. And that's to be expected, because a lot of index funds and retail investors, institutional investors, ended up after the We Buy Cars with, call it, a 2/3 holding in We Buy Cars. And there's 1/3 of this thing left over that you have nasty nightmares of, being Transaction Capital. And everyone has been selling their Transaction Capital the moment they could from yesterday. So at some point, I think the selling will subside, and this is their opportunity to get in, because I do expect that Newton will be stabilized now. It might not even not be listed a year from now if the management team does a management buyout or something like that. But I do think that it's worth double the current share price. Sure. And as long as this forced selling subsides a year from now, things might look very different for Transaction Capital.
Okay. Graeme, how about you?
So Julieta, in the dark days of COVID, I think it was in July 2020, I suggested that we we buy that dirty fossil fuel company Shell, which is London listed. I think at the time it was £12. The oil price was in the doldrums. And sometimes it's nice to close the loop. I think we said it was a tactical thing. We weren't, we just felt that it was worth more. It's sitting at about £28 or thereabouts. In this 3 or so years, you probably earned £3.5 worth of dividends. So, I'm in the camp that says that fossil fuels are in their sunset phase. You can just see the explosion in EV, for example. So at the margin, I believe that demand will start to taper off for the products that they produce. And against that backdrop, I would argue that, 5 or 10 years from now, you definitely don't want to be owning these fossil fuel companies. So we've made good money. It's been rewarding, and particularly because of the spike courtesy of the Middle Eastern tensions and OPEC, the oil price has kicked up, and that's taken the share price higher. So I think it's a good time, if you followed that recommendation, and if you don't want to sell all of them, sell 60%, you're left with a free ride. And but it's been quite kind, and I think it was a good opportunity for us way back then.
Yeah, okay. A pick and a sell. Jean Pierre and Graeme, thank you very much for joining us this evening. Always a delight to speak to you both. Jean Pierre Verster is from Protea Capital Management. Graeme Körner is from Körner Perspective. And up next, the close. Stay with us.